Well, so much for a healthy stock market. Last week I discussed how the markets weren't looking bad enough to take defensive action. Some indicators looked very good while others were just starting to degrade. Well, early this week, that all changed. On Tuesday, we hedged our clients' accounts to protect against downside, and I'll show you why. You have to be very careful if you're going to even try to actively manage risk in a portfolio. In fact, I encourage you not to try and time the market. The reason I publish these videos is so you have information about what's going on in the markets, and hopefully that'll make you less stressed out as the markets drop. The problem with trying to time the markets is if you reduce risk too soon, you'll often miss further upside because the pullback wasn't that bad and the market just takes off and leaves you behind. On the other hand, if you wait too long to reduce risk, your changes won't benefit your portfolio on the way down, and you'll most likely miss the run-up off the bottom. To make matters worse, you have to be correct twice if you actively manage your portfolio. Once when you reduce risk, and then a second time when you put the risk back on. Again, I recommend you don't try to time the markets because it's very hard to impossible to get the timing correct. So don't try this at home. Early this past week, the risk in the equity markets became much clearer. So let's look at what's going on and what kind of risk profile the stock market's presenting right now. So if we look a week ago, on Friday, February 17th, you can see that over the previous week, we had a somewhat healthy rally going on here with ARK Invest, the riskiest stocks, going up the most, followed by small caps, followed by the NASDAQ, and then followed by the Dow and the S&P. So this is a healthy looking rally, except for the fact that over the last 2 days, it kind of fell back and then tried to recover a bit. So what does that look like this past week as of today, February 24th? Well, if we look at this for today, it doesn't look healthy at all. We've got ARK Invest, the riskiest investments, down the most for the week, followed by the NASDAQ, and then followed by the Dow and S&P 500. So this is a very unhealthy looking market right now. And what if we look back over the past month? Well, you can see here that the markets tried to rally, peaked out here, and then you can see that ARK Invest, the riskiest stocks, have been falling the fastest here. In fact, let's take a look at that. So if we draw an arrow here from the peak down to here, you can see how fast that's been falling. Let's take a look at the NASDAQ. How has the NASDAQ been falling since that peak? It's a more gentle slope, not quite the bunny slopes, but maybe intermediate. And then if we take a look at the S&P 500, you can see that's an even gentler slope. And then if we finally look at the Dow, the safest stocks, there's really not much going on here at all. It looks slightly less slopey than the S&P 500. So this is very unhealthy. You have the riskiest stocks falling the fastest and the safest stocks falling not so fast. And what if we look back over the past 6 months? Well, you can see we had an unhealthy rally here where the Dow was going up the fastest. Let's put an arrow on that so you can see it. So if we look here from this bottom, the Dow went up very nicely here, but I'm just going to look at go from the lowest risk to the highest risk stocks. And if you look at ARK Invest, it didn't go up nearly as fast as the Dow. That's a very unhealthy attempt at a rally, and you don't want that. Now, what about back here where we started going up? Well, if we look at ARK Invest slope, it's very, very steep. And if we look at the Dow slope, it's anemic. So this is a very healthy rally. And then what's happening now that the markets are falling backwards? Well, it's the same story that I said earlier. You've got the Dow stocks not falling very much, but you have the riskier stocks in ARK Invest falling much more rapidly. So this is a very unhealthy stock market, and it's not even trying to go up, it's going down. And again, you have to take the long view. So if we look back over the longer term, you can see that the NASDAQ has handily outperformed the the S&P, which has outperformed the Dow and the small caps, but ARK Invest has really gotten just absolutely trashed here. So hopefully if we get into a healthy market, ARK will come back and pass all of these other ones up. Interesting things going on with the bottom dynamics right now, because what you see here is we actually have a bottom forming indication right now as of the close today, Friday, February 24th. You can see we've got a very high level of bottom forming indicator here, and we've got a fairly high level of confidence here. That combination says that there's a bottom forming. Now, does that mean this is the bottom? No. This could continue to fall, and this could go up to 100% and stay there for a while. So we won't know that we've seen a bottom until we get a bottom confirmation. And how does that happen? Well, this blue line has to come all the way up here, up near 100%, and the confidence level has to stay up. So we had a bottom confirmation back here. You can see that right here. And the market started going up after that. So we're not anywhere close to calling a bottom here. And what about our risk metrics? Well, last week I said, the markets really, it wasn't time to turn tail and run because these metrics were way down here. This red risk metric was sitting here at about 35, and the risk acceleration was down here pretty close to 10 or 15. I mean, that's ridiculously low risk. But look at what's happened in the past week since that discussion. You can see that the risk acceleration has just gone through the roof. It's above 80 right now. That's very, very scary. Now you can see that the risk level, this red line, is shooting up here, but it's pulled back as of today. I'm not sure what that means or where it's going, but we really need to see this risk acceleration come back down here to around 50 or lower before I feel comfortable that we're out of the woods in this current downturn. And what about equity versus safety? I like equity versus safety because it happens very quickly. It gives you readings very, very quickly. It looks over a shorter time period, so the readings that you get are more timely. And what you can see happened here is, let's go back 4 weeks ago. You had a very healthy stock market here with the NASDAQ and small caps ranked 1 and 2. And you had a healthy treasury market with long-term treasuries, EDV and TLT, ranked above T-bills and intermediate treasuries. Now, it was a little disconcerting because cash was still fairly far up here. So maybe that's a warning sign right here. And you can see the following week, cash moved up even more, and small caps started to fall. And we had an unhealthy treasury market here. So unhealthy treasury market, cash moving up, equity still looked somewhat healthy here. Fast forward another week, cash is ranked the number 1. That's pretty scary. But you have IWM and the NASDAQ 100 ranked just behind it. So this still looks like a somewhat healthy relationship for equities. But now let's look at today. And you can see that we not only do we have cash number 1, we've got T-bills ranked in 2nd position and intermediate treasuries in 3rd position. And the NASDAQ has dropped down below SPY. And I'm assuming if this keeps going, the NASDAQ will fall down below the Dow. And again, we have an unhealthy treasury market with longer duration treasuries ranked down here at the bottom. So how does that show up in buying and selling pressure? Well, this is kind of an interesting picture that I'm seeing here. So you can see for the Dow, we had a nice rally going on here. It pulled back. And actually, this pullback was healthy because what was happening is people were dumping these safe stocks and putting them in riskier equities. But then the Dow rallied again, and now it's really starting to drop. But what's interesting about this is that the selling pressure, the solid orange line, isn't very high here. In fact, it's down here right near the buying pressure. So there's no real strong selling pressure going on for the Dow right now. But what about the S&P 500? Well, for the S&P 500, we have a strengthening selling pressure. You can see that the trend over 1 month is moving higher and the buying pressure is dropping. So this is a stronger downward move with more force behind it because of this increasing selling pressure. What about the NASDAQ 100? Well, the NASDAQ 100 doesn't look that bad, surprisingly. I mean, you look at the selling pressure, yes, it is pointing higher here. So if this continues, then there's going to be some push behind this current drop. But until I see this moving up higher, I'm not terribly concerned. And same thing with small caps. You've got a pullback here, and the selling pressure and buying pressure are just kind of trading places here. It's sort of like it's kind of almost going sideways and consolidating. But when you start to look at ARK Invest, the riskiest investments, you can see that the selling pressure is on a very steep decline. In fact, more recently has really started to shoot up here. So this is concerning. Now, what about the sector rankings? Well, the sector rankings, if you remember, move much more slowly than, say, equity versus safety or looking at the buying and selling pressure. And so, these are still showing technology ranked number 1 up here, emerging companies down here, and technology and so on. So this almost looks healthy, but what I don't like is that consumer discretionary is way down here and consumer staples are sort of in the middle of the pack. This is not totally positive. But if we look at sector acceleration rankings, these move much more quickly, and you can see that happening here. You can see cash is way up here. Shorter duration and longer duration treasuries have moved up here. So this is not a good look at all. And consumer staples is well above consumer discretionary. So this is showing not a good look for equities right now. If we look at treasuries a week ago on February 17th, you can see we had a very unhealthy treasury market. The purple line are the highest risk treasuries, followed by TLT 20-year, and then 7 to 10 year. So this is a very, very unhealthy looking treasury market. What about this week? So if we fast forward to this week, it's sort of flipped over in a way. We have the longer duration, higher risk treasuries doing better than the safer treasuries. But it's kind of a mixed bag here because the shortest duration ones are in the middle, and the intermediates and sort of intermediate to long treasuries are down here, and then the longest duration ones are up here. So what the heck is going on? Well, to understand this craziness, let's take a look at the inverted yield curve. So we've got an inverted yield curve, and this is, by the way, a week ago. So this is on February 17th, and the difference was minus 78.35 basis points between these two yields. Well, what if we move ahead to today? Well, it just got worse. So now it's even worse. It went from minus 78 to minus 81.51. So this is getting even more inverted. This is going to have to break at some point. And in order for it to break, you're going to have shorter treasury yields come down or longer duration treasury yields go up, or some combination of the two. But we're not even close to having that happen yet. And how does that show up in the buying and selling pressure? Well, you can see that intermediate treasuries have really kind of been tanking here. And you can see the selling pressure has been well above the buying pressure. So this is not looking very good. And if we go out a little bit longer to 7 to 10 year treasuries, similar picture, but you can see actually that the selling pressure has been on a somewhat of a declining slope here. It was much higher here, lower, and now even lower. So maybe this could turn around if the selling pressure continues to decline as it's showing here. But what's interesting is the buying pressure is also showing a decline. So this is not looking great in either case. I just don't know what to make of this. If we look at these 7 to 10 year treasuries, it's kind of an interesting picture. Yes, the price is dropping, but if you look at the selling pressure, the slope of it is also declining. You can see that here. But what's also interesting is the buying pressure slope is declining. So I'm not sure where this is going. And what about long bonds? Well, if you look at long bonds, it's a little more definitive here. You've got selling pressure. Yeah, it was very high back here. And now it's been increasing over the last month and a half or so, as you can see here. And the selling pressure is currently well above the buying pressure. So this is not looking good for long-term treasuries. And what about gold? Well, similar picture, dropping price and increasing slope on the selling pressure, decreasing slope on the buying pressure. This is not looking good for gold. Now, Bitcoin's been kind of interesting lately. It's been showing some strength, whereas equities and treasuries were dropping here. Bitcoin was sort of trying to rally a little bit. It's not really showing up here in the buying and selling pressure. You can see that the buying pressure, this gray line, has been on a declining slope, while the selling pressure has been steadily increasing and is now pointing higher. So I wouldn't necessarily jump into Bitcoin right now until we see this selling pressure turn around and the buying pressure move higher. So where does all this leave us? Right now, the markets are looking very unhealthy. While the markets have been declining, I don't see that much conviction in the selling pressure. So for right now, we're just going to have to buckle up and wait for signs of a market bottom combined with higher buying pressure, lower selling pressure, and a healthier sector ranking relationship between these various sectors. We want to see cash moving down. We want to see riskier sectors moving up into the better rankings. So for now, we're just not even close to that. I'm Calvin Rose, and thank you for watching Invest Smarter this week. That's all for now.